You need to stop trading every market structure shift because it is ruining your trading. But instead, I want you to follow these 3 steps to simplify ICT market structure into a strategy that I use to become profitable and get funded with multiple prop firms. Look, I understand how hard it can be to find the right structure because before I used this strategy, I was looking at every single high or low, looking way back left on the chart, trying to map out market structure. And this causes so much confusion and it will hurt you more than it will help you. So in this video, I'm going to break down the easiest way to find market structure that you will ever find. And once you implement these 3 simple steps to your trading, it's going to change overnight. So enough of the chit chat, let's get started. The first step to plotting market structure correctly is to know the basics. So in step 1, we are going to focus on the 2 core fundamentals of market structure. They're both very simple, but they're also very important and often overlooked. So the first step to plotting market structure is highs and lows, right? And you have to know which ones to pay attention to. So first off, any swing high or low is to be paid attention to. Don't overcomplicate this by looking for, what low made a high or old structure. And I know a lot of you do that because I used to do that, right? What you need to focus on is just any candle that has a higher low on either side of it, right? See how this candle right there has a higher low on either side. This candle's low is lower than this one and this one, so that would make it a swing low, okay? And if we look at this candle right here, that candle's high is higher than the candles on either side of it, so that would make it a swing high. So don't overcomplicate this, and we're going to get back to this later, but just know that that is how we determine what a high or a low is. So the next thing we're going to talk about is premium and discount. So in essence, premium and discount is just our tool to buy low and sell high. Now we're going to have to draw our premium and discount at specific structure points to determine the dealing ranges we are currently in, and I'm about to show you exactly how to do that because most of you are doing this wrong. But in essence, I want you to focus on the fact that the market is always traveling from internal liquidity, meaning liquidity that is inside of the range, aka fair value gaps or equal lows or any kind of old lows within a range, and it'll travel to external liquidity, which is going to be the pro-trend opposing liquidity. So for example, if we're bullish, we're going to travel from internal liquidity, meaning bullish fair value gaps or under old lows or order blocks, into buy-side liquidity, right? And as long as we keep pushing and show the intention with impulse, we are going to continue among this path. Now, if you want to trade counter trend, it's okay, but you need to be aware that if you're taking a trade up here, you're just going to some kind of internal liquidity inside this range rather than trying to target the low. Because if we're bullish, then you're just looking for discount or maybe the next close by PD array at a 2R or something that is good for you. But it's very important to understand premium and discount to be aware of the market you're trading in. But again, you must map this out on the right structure, and to know the right structure, you need to know how to draw impulses. So let's go ahead and move into step 2 of simplifying ICT market structure. So here's where we get into something that few ICT traders know about, but if they did, their trading would become so much clearer and they would become profitable much faster. In order for market structure to be valid, you must have an impulse. An impulse can be viewed by understanding displacement, which is just a big undeniable push through, not to, through structure. Now, to draw impulses and understand displacement, we must understand these 2 simple rules. So rule number 1, and this is what a lot of people do know, is that yes, you must have a candle closure above a high or low. But a candle closure is not enough. So that leads us into rule number 2, which is that we need to see a big push after structure has been taken, right? Not on the way to it, but after structure has been taken, okay? The key here is that if you don't see this big push, you're not looking at this as a valid impulse, and you're not looking at it as something that's likely to continue. For example, it's just like if we wick below a candle just like this, we're expecting that to then reverse. And it can be the same thing even if you get a candle close if you don't get displacement, right? Because if we don't get displacement, it's likely manipulation. So again, a closure is not enough. We need to see follow through, right? We need to see a big and undeniable push in order to map out the market structure that you want to pay attention to. So yes, all highs and lows matter, but we're going to be using those as tools to draw impulses. So we're going to use our highs and lows to see what low caused a big push that took out a high with displacement. So a good example of that would be right here. Now, some people may have waited for this structure, but that is not how you're going to be mapping structure if you're going to be following my rules. You're going to be using any high or low, and if you see displacement through it, then now you have a new impulse. So you would look at this as your current dealing range, and then once we start to form a high where the market starts to cool off, you would then draw your premium and discount and only pay attention to this range. We're not going to draw from the lowest low to the highest high for impulses, okay? This is going to get you the meat on the bone, and it's going to give you what you need in order to trade on a day-to-day basis, and it's going to filter out, trying to look left and all these different ranges that you'll just get lost in. So again, you need follow through after the structure. Notice how right here, we wouldn't necessarily have called it, on this candle. We would have waited for that big push through and then said, okay, that is a market structure shift, or this is an impulse that we're going to be paying attention to. And this is how you should mark everything from your bias structure on your higher time frames all the way down to your lower time frame entries. Trust me, this is how you get the meat on the bone and how you filter out a lot of the phony structure. So let's hop on a chart and look at this just to get a better visual, because at the end of the day, you guys need to see it on a real chart. So what we're going to do is we're going to map an impulse from here until we start to run out of juice. And this is a little subjective, but you just look at the market and see when did the market really cool off and get a decent retracement. And if you can see right here, the market retraced, it came right back to a discount. When you map out structure like this, it's going to take some practice, but you need to just focus on mapping the impulse, mapping the meat on the bone, so to speak. So then after the market comes back down into a discount, so then what we're going to look for is where was the next impulse, right? Where did we take out the structure again? And that's right here. So if we look again, we have a low right here, and where did the market start to pull back? It's up here. So you could now move your range to that new low and high. And this is going to give you what you want to pay attention to, or the valid structure, the true direction of the market, where it is reaching, right? So then what we want to look at is, okay, when did the market really start to displace? Is that a displacement right there? No, it's not. Just because it closes a candle does not mean that that's new structure. That's why I don't subscribe to that methodology. But when we push through here, we notice that. So this is where the way that I map structure is going to be a lot different than most people, and this has worked much, much better for me. We're not going to go all the way down here and say, okay, we're going to map out this entire big push as far as our impulse structure goes, because we want to ask ourselves, where's the meat on the bone? Where did the market really start to push from? And we're going to pay attention to the most recent low that caused this big push and then draw it to where we started to pull back. And you'll see over time that this becomes much easier to do because it's not as subjective as trying to find out some structure way over to the left or old structure when you need to be paying attention to what's happening right now. So we would then pay attention to here and then wait for the next time this happens. Boom, we get a big push up above, some follow through, and at this time, you're going to map just this little bit of structure out. Notice I'm not saying that it has to take out the old structures high, okay? It does not have to take out the old structures high because you're operating on a more dynamic and nimble basis that's going to allow you to operate on a much, much faster pace when you're day trading, okay? So look, the market comes back down to a discount of this range, and here's a little tip. If you go on a lower time frame, this is going to be a bigger range that you can dissect further. We're on a daily chart right now, but then again, you're going to wait for the next displacement, which we have right here, and then boom, you've got a new impulse right there. And the market comes back down to a discount. You get another impulse right here. The market continues, but I want to be very clear that this isn't just going to continue forever, right? Every trend comes to an end. So that brings us right into step 3, which is how we're going to predict where to look for those reversals. Before we start step 3, I want you to download the free PDF guide that's in the description because videos are great, but videos with ebooks are better. And plus, it's going to be easier for you to have that with you while you're trading instead of just trying to rewatch this video time and time again. So for step 3, I want you to stop getting glued to one time frame and getting lost in it because that's just going to kill your win rate and stress you out. But instead, I want you to follow 2 simple rules when mapping out your market structure. And rule number 1 is that the high card rules. You must always operate in context of the higher time frame. For example, if you have some bearish impulse on the 1 hour, like let's say the market pushes down on the 1 hour and you have an impulse and you're saying, okay, here's my structure. Well, this could be just part of a bigger impulse on a daily time frame, okay? So you have to be aware of where you're at on the next time frame up. And we're going to go over a very simple way to do this so you don't get lost in a bunch of time frames because you really only need a couple. So rule number 2 is no matter what time frames you select out of the list I'm about to give you, you always watch the weekly and daily time frame. I don't care what you say, you have to watch these time frames, whether you're trading the 1 minute or the 1 hour, right? These are going to be the most powerful time frames, and they're going to help you with so much stuff that we're going to get into later in this 5-video series, but you always have to be aware of where you're at on the weekly and daily time frame. This is going to simplify your bias and give you a solid foundation to build on, so again, do not skip this. So let's take a look of why this is important, okay? So let's take a look at the weekly chart of NASDAQ, right? We have this massive impulse where we have a clear discount, and we've got a fair value gap here, and the market is down here in a discount. But let's just say if you didn't know that and you're just looking at the daily time frame and you're saying, okay, well, we displaced to the daily, so I'm going to short right here in this zone. Well, obviously that didn't work. And there are other ways you could have maybe saved yourself from doing it, but a really easy way is just being aware of where we're at on the weekly time frame. Because if you're aware that the market is in a bullish impulse in a discount, you're looking at that daily impulse down to be invalidated because the high card rules. So if you have 2 time frames that are conflicting each other, always go to the higher time frame and listen to what it's telling you. So there's a rule number 3 that I'm adding in here. But this is just because trying to map structure on every single time frame is just going to result in paralysis by analysis, and it's overall just a mess, and it's super stressful. So you need clean charts. So here are some very good and solid time frames to use. So what this means is like you would use the weekly as your highest time frame, the 4 hour as your medium time frame, and then the 1 hour as your entry time frame. And then don't map structure on 25 other time frames and have fibs drawn everywhere and lines everywhere on your chart, because then you're never going to be able to trade effectively, because there's always going to be either a reason to trade or a reason not to trade, because you have 50 different things telling you different things to do. So I want you to pick one of these time frame sets and stick with it. Personally, I use the daily to the 1 hour to the 1 minute, and I do look at the 15-minute sometimes as well. I'm not saying you never will ever look at other time frames to find PD arrays or levels, but at the end of the day, when you're mapping out your impulse structure, this is all you need. But again, always use the weekly and daily, right? You have to. Even if one of these says only daily, always pay attention to the weekly as well. So congrats, and thank you for making it this far in the video. Make sure to subscribe, because this video is the first of a 5-part series that is going to give you everything you need in order to become a profitable trader. This is what a lot of other people are charging money for, and I'm going to go over it and teach you the simplest strategies that you're going to be finding anywhere, right? You could literally teach this to your family, you could teach it to whoever, and I'm creating it in a way that is so easy to understand that anybody could learn it. But I want to be clear and tell you to always remember that information without application is nothing but knowledge, and knowledge pays you nothing, while action can change your life. So that being said, here is a clear set of action steps to follow after watching this video. First, I want you to download the free PDF, because again, this is going to be easier for you to watch while you're trading. It's totally free. 2, I want you to keep it up when you're mapping market structure, right? Just have it either on your phone or somewhere on your screen. If you have 2 screens, have it on your other one. Somehow have it up while you're trading. And number 3 is just to make sure you're aware of what impulses you're in on the higher time frames at all times. You can even get watermark indicators on TradingView or use the text tool to just keep it in front of you, right? Being aware of things and just making it easy to do the right thing is always a win in my eyes. Look, I firmly believe that each and every one of you watching this has what it takes to become a successful trader. I mean, just by watching this video and finding me, it shows that you've invested in yourself by education and spending the time to do this. My biggest advice to you guys is never give up and always submit to time. When it gets hard, just remember that nothing good comes easy. And yes, trading is going to be hard, but once you master it, you unlock a world of freedom that you will never truly understand until you reach it. And again, thank you for watching the video. Don't forget to subscribe, and always remember that if you can't see the liquidity, then you are the liquidity.